Welcome to today's explainer. Okay, let's get right into it because today is an absolutely massive day for the Indian stock market. It's June 15th, 2026, and we are unpacking the highly anticipated debut of Vedanta Oil and Gas Limited, or VOGL. This is the result of a historic demerger from its parent company, Vedanta Limited. Basically, the iconic Karen brand is finally stepping out on its own.
To really wrap your head around the scale here, we're talking about a 13,400 crore rupee market cap right out of the gate, trading around 36 rupees and 10 paise. And man, the market is eating this up. We've already seen a heavy trading volume of over 2.45 crore shares today. This isn't just some minor spin-off. We are looking at India's largest private sector exploration and production company hitting the streets. Here's our quick roadmap for today. First, VOGL key market entry. Second, paisa kaise aata hai. Third, competition and market position. Fourth, positives, the bull case. And finally, risks, the bear case.
All right, Section 1, VOGL Key Market Entry, Tracing the Demerger Journey.
Now, getting to today wasn't exactly an overnight thing. This business was locked inside a massive metals conglomerate for years. The National Company Law Tribunal actually gave the green light for the demerger back in December 2025. Then came May 1, 2026, which was the critical record date. It worked on a simple 1-to-1 ratio. So, if you held 100 shares of Vedanta Ltd, boom, you automatically got 100 shares of VOGL. Also, just as a factual note on the timeline, from June 1st to 3rd, the Enforcement Directorate conducted a search related to FEMA regulations. The company stated it didn't impact operations, but it's certainly part of the journey leading right up to today's official listing.
Because of that 1-1 demerger ratio we just talked about, VOGL's ownership structure is practically a mirror image of its parent. The Anil Agarwal Group is firmly steering the ship here, with a massive 56.4% majority stake. You've also got a solid chunk of foreign institutional investor interest, sitting at 17%, with retail and domestic institutional investors taking up the remaining slice of the pie.
And speaking of the promoter, Anil Agarwal actually made a pretty bold statement to the media today. He said, hard demerge business, ek din $100 billion worth ka hoga. I mean, that is a wildly ambitious vision for the future, right? But hey, as investors, we have to buy into reality, not just the vision. So let's peel back the layers and look at the actual engine driving that 13,400 crore valuation.
Which brings us to Section 2, Paisa kaise aata hai? Decoding the core business.
So how does VOGL actually make its money? Well, they are strictly an upstream operator. In simple terms, think zameen se nikalna, literally pulling it out of the ground. They aren't running retail petrol pumps and they aren't refining chemicals. The entire capital-heavy business model revolves around the high-stakes game of exploring and extracting crude oil and natural gas straight from the earth. That's the whole shebang.
And where exactly is all this extraction happening? Their absolute crown jewel is the Rajasthan block, specifically the Mongala, Bhagyam, and Aishwarya fields. This area was actually India's biggest onshore oil discovery in over a decade. We're talking about a resource potential of 7.3 billion barrels of oil equivalent. That's a staggering amount of energy. Their business model is entirely B2B. They pull the crude out and sell it straight to domestic refineries like IOC, BPCL, and Reliance. Plus, they've set a really aggressive target to ramp up production to 150,000 barrels of oil equivalent per day by FY29.
Moving right along to Section 3, Competition or Market Position, Clearing the Confusion.
You know, if you've been scrolling through market forums today, you've probably seen folks confusing VOGL with companies like Adani Total Gas or Indraprastha Gas. But honestly, it's like comparing apples and oranges. Adani Total Gas is downstream, meaning they pipe already extracted gas into homes and CNG stations. It's a stable, regulated distribution game. VOGL, on the other hand, is upstream. They take on the massive risks of exploration, and their revenue is 100% at the mercy of global Brent crude prices.
So, who are they actually competing against? Their true peers are the government-owned PSU giants, ONGC and Oil India. Now, ONGC obviously dwarfs them in sheer size, but VOGL has a very unique edge. It's India's largest private exploration company. This gives them a level of agility and private management speed that you just don't typically see in state-run bureaucracies. And since VOGL is a fresh, pure-play listing without all that old conglomerate baggage, analysts are eyeing some pretty high re-rating potential here compared to the already priced-in PSUs.
Let's look at Section 4, Positives, the bull case. Why investors are watching.
Okay, why are the big institutional funds and retail investors keeping such a close eye on this stock? Well, the strongest argument is that it's a totally clean slate. If you want exposure to oil and gas, you no longer have to buy a metal mining business to get it. Second, and this is absolutely crucial, macro alignment. India imports over 85% of its crude oil. The government is desperate to boost domestic production, so VOGL's core mission is perfectly synced with India's national energy security goals. Throw in their locked-in roster of major refinery clients, which gives them great revenue visibility. Oh, and surprisingly, they're killing it on ESG metrics, reporting a 25% absolute drop in carbon emissions over the last 5 years. That's a huge green flag for modern funds.
Now for Section 5, Risks, the bear case, the red flags.
We always have to flip the coin, right? What are the factual headwinds that could drag this stock down? The biggest risk by far is something they can't even control, the commodity cycle. VOGL's revenue is 100% tied to global Brent crude. If global oil prices tank, VOGL's earnings take a direct hit. Simple as that. Second, those massive Rajasthan oil fields, they are maturing. That means natural drops in reservoir pressure, making it harder and more expensive to extract oil over time. We also need to impartially mention a couple of overhangs. That recent unresolved ED search regarding FEMA rules definitely adds a layer of regulatory uncertainty. And we can't ignore that their London-listed parent company, Vedanta Resources, carries significant debt. Historically, parent debt can create pressure to squeeze heavy dividends out of profitable subsidiaries like VOGL.
Just a quick practical heads up for anyone looking at the ticker today. VOGL is currently in the trade for trade, or TTT segment, for its first 10 sessions. That means absolutely no intraday speculation is allowed. If you buy it, you're taking delivery. They've also slapped strict 5% upper and lower circuit filters on it, so fully expect some liquidity constraints and a bit of choppy price discovery over these next 2 weeks.
So what's our final verdict here? Well, VOGL is pretty much the textbook definition of a high-risk, high-potential asset. It gives you this unprecedented, pure-play access to India's private oil production sector, but you are firmly strapped into the wild roller coaster of global commodity prices. As always, you've got to do your own research, because this specific sector requires a very strong stomach for volatility.
I want to leave you with a thought to chew on. VOGL has the aggressive targets, they have a massive domestic market practically begging for their product, and they have that nimble private sector agility. But when the global price of crude oil ultimately writes the rules of the game, can VOGL's execution actually outrun the inherent risks of the commodity cycle? It's going to be fascinating to watch how they perform in the coming quarters. Thanks so much for hanging out with me for this explainer, and keep learning.